All right, listen, right now there's a consensus pouring in the personal finance community. It's that international stocks are a waste of time. I mean, you see it everywhere. Reddit threads saying just VTI and chill, YouTubers telling you to skip VXUS, even some financial advisors that are quietly reducing their international allocations. And they all point to the same thing. You see, over the last decade, international stocks have gotten absolutely crushed. $10,000 invested in US stocks 10 years ago, well, that's $34,257 today. $10,000 though invested in international stocks would have only been worth $17,424. You would have nearly doubled your money by staying 100% in the US. So I decided to dig into the data myself. I pulled 53 years of historical returns every single year from 1971 all the way to 2024. US versus international, to settle this whole thing once and for all. And what I found completely changed my perspective. Because here's what nobody's talking about. If you go back to 1971 and invest $10,000 in each, US stocks would be worth $2.5 million, while international stocks would be roughly $2.4 million. The difference, $140,000 over 53 years. That's only a 5.8% gap. They're basically the same. And here's the part that really surprised me. For 47 years, from 1977 to 2024, international stocks were actually ahead of the US. And in 2007, international was beating the US by $926,000. So it begs the question, what happened? Why is everybody convinced that international stocks are a waste? And what does the actual data say that you should do with your own portfolio? That's what we're covering today. So yeah, listen, if you've spent any time in investing communities over the last few years, you definitely know the vibe that I'm talking about. International stocks are just dead money. And I get it. The recent data is absolutely brutal. I mean, over the last 12 years, the US stocks have returned over 14.6% annually, and international is just 6.2%. That's not a rounding error. That's a massive sustained divergence. You see, in 2014, you might have had $100,000 split between US and international stocks. By 2024, your US allocation grew to $343,000, while your international grew to just $174,000. You would have twice as much money today if you just ignored international entirely. And this isn't just about returns, right? The standard argument for international diversifications have also broken down. Remember the whole point of diversification altogether? When one zigs, the other zags. The correlation between the US and international stocks used to be around 0.42 back in the 1970s. That's good diversification. Today, it's 0.92. That means that they move together 92% of the time. So what are you even diversifying from? And the idea that international stocks protect you during crashes, I looked at every single major market downturn since 2000. In 2000, 2001, and 2008, the three biggest crashes, international stocks fell more than US stocks. They were supposed to be your insurance policy, but the insurance didn't pay out when you needed it most. So based on all of this, the case for going 100% into US stocks seems pretty straightforward, right? But here's where it actually gets interesting. So you see, when I started pulling the data, I expected to see US dominance going back decades. I mean, that's what everybody talks about. US stocks always win over the long term, but that's not what the data actually shows. I mean, let me walk you through what actually happened decade by decade. So we've got 1972 to 1982. International stocks returned 13.1% annually. US, just 6.7%. International crushed it. Then we've got from 1982 to 1992, international 23.1%, US 16.2%. International crushed it again. Then from 1992 to 2002, this was the US's moment, right? 9.3% versus international's 5.6%. The dot-com boom, the US dominated. So from 2002 to 2012 though, well, international came back. 8.7% versus 7.1% for the US. International won the early 2000s. And then we actually have 2012 through 2024. It brings us to the current era where the US is about 14.6% and international is 6.2%. US is dominating. Now here's what that looks like when you track who's ahead over the last 53 years. International took the lead in 1977, and they held it for 47 years. In 1993, at the peak of international outperformance, they were ahead by $518,000. You see, in 2007, right before the financial crisis, they were ahead by almost $1 million, $926,000. It wasn't until 2024, literally last year, that the US stocks finally caught up and pulled ahead. So when somebody tells you that US stocks always outperform, well, show them this chart, because what the data actually shows is cycles, long cycles, each lasting 10, 15, sometimes 20 years. International stocks dominated from the 70s through the early 2000s. The US dominated from the 1990s to the 2010s. And after 53 years, they're basically tied again. 2.5 million versus $2.4 million. An annual return difference of just 0.12%. Over half a century, that's definitely just a rounding error. Now you might be thinking, okay, but that's ancient history. Something fundamental has changed. The US is different now. And maybe, but let's talk about it. So listen, there's two ways, in my opinion, that you can interpret the recent US dominance. Theory one is that this time is different. The argument goes like this, okay? The US has structural advantages that simply didn't exist before. The dollar is the global reserve currency now. US tech companies, Apple, Microsoft, Google, Amazon, are among the most innovative in the world. American capital markets are deeper and more efficient than ever. US regulatory environments are way more business friendly. And yes, there is truth to all of this. I mean, the US is home to the world's most valuable companies. 7 of the top 10 companies by market cap are American. The Magnificent Seven alone represent trillions of dollars in market value. Plus, the US economy has consistently grown faster than Europe and Japan over the past decade, and that shows up in earnings growth. US companies have grown earnings at 8 to 10% annually, while European companies more like 4 to 5%. That's a real difference. So maybe, just maybe, the old cycles don't apply anymore. Maybe we're in this new era where US structural advantages persist indefinitely. And then there's theory two. This is just another cycle. But here's the counter argument to, the first option here is that people have said this time is different at every single peak that we've been at. I mean, in 1989, everyone thought Japan would dominate forever. And I'm going to butcher this, but the Nikkei was at 39,000. Japanese companies were on top of the world. They're buying places like the Rockefeller Center. They're buying Pebble Beach. But by 2003, the Nikkei had dropped 80%. Now, it still hasn't recovered to 1989 levels. And in the late 1990s, everyone thought that the US had entered a new economy where valuations really didn't matter. Then the dot-com crash happened. And in 2007, emerging markets were the next hot thing. The BRICS were going to take over the world. But then 2008 happened. And now we fast forward, 2024, 2025, we're hearing all about the same thing, US dominance. And look at valuation. I mean, last year, the S&P 500 traded at a PE ratio of 24.5. That's 37% above its historical average. International developed markets, 14.2 PE. Emerging markets, 12.8. Now, maybe those valuations are justified. Maybe US companies deserve to trade at double the multiples of international companies. Or maybe, like every other time in history, mean reversion will eventually happen. And here's what concerns me about the US's permanently better argument. It's the correlation. You see, if US and international stocks are 92% correlated, that means that they're driven by the same global economic forces. When there's a global recession, they both go down. When there's a global expansion, they both go up. So if they're basically the same bet, why does one deserve to trade at 2 times the valuation than the other? I don't know the answer to that. Nobody does, but it makes me skeptical of the permanent US dominance narrative. Now, there's one more thing that I really want to talk about here, and it's John Bogle. John Bogle literally founded Vanguard. He invented the index fund. He's the reason that you can actually invest in the S&P 500 for just a 0.03% expense ratio. And his position on international stocks was clear. You don't need them. His recommendation was 0 to 20% international max, and he specifically said a zero weight is fully acceptable in most portfolios. Now, his reasoning, currency risk, political risk, regulatory risk, and the fact that US companies, well, they already get about 40% of their revenue from international markets. So you already have global exposure. Now, here's the irony to this. The company Bogle founded recommends 40% international. So who's right? Well, based on the last 12 years, Bogle looks extremely smart. If you'd followed his advice and held 0 to 20% international, you'd have done way better than the Vanguard target date funds with their 40% allocation. But based on the previous 40 years, well, the 40% allocation looks completely reasonable because international and US were basically tied over the long run. So Bogle's recommendation might be right now, but it was arguably wrong for most of his career. And Warren Buffett, by the way, he agrees with Bogle. His recommendation for his wife's trust, 90% S&P 500, 10% bonds, 0 international. But Buffett also famously said, be fearful when others are greedy and greedy when others are fearful. Right now, everybody is greedy on US stocks and they're fearful on international. Vanguard's own research shows that 26% of investors' assets are in international funds, well below the market cap weight of 40%. So by Buffett's own logic, maybe this is the time to add international exposure, not reduce it. Okay, so listen, after 53 years of data, multiple cycles, and a lot of conflicting signals, what should you do with your own portfolio? Well, let me give you both sides and then I'll tell you what I'm doing. First, the case for reducing international to 0 to 20%. One, recent performance has been absolutely terrible and 12 years is an extremely long time. Two, correlation is extremely high. You're not getting much diversification benefit. Three, US companies already give you global revenue exposure. Four, John Bogle, one of the smartest investors ever, is recommending 0 to 20%. So that's got to weigh into here. And five, if something has fundamentally changed, you don't want to be overweighted in an asset that's structurally disadvantaged. Okay, so this is a totally reasonable position in my opinion. And if you want to go 0 to 20% international, well, you're actually in great company. Here's the case for keeping international 20 to 40%. One, 53 years of data shows near parity. Cycles are real. Two, international was ahead for 47 of those 53 years. The recent period might be an anomaly, not a new normal. Three, valuations are dramatically lower. You're getting international stocks at half the price of US stocks. Four, mean reversion is a powerful cycle. Every permanent shift in market history has eventually reversed. And five, if you believe in diversification philosophically, now is probably exactly when you need it most, when it's the most painful to go into it. So this to me is also a reasonable position, and it's actually what most institutional investors are still recommended. So what am I doing? Well, I actually currently hold VXUS. It's about 10% of one of my portfolios that I have working towards retirement. And here's the thing. I don't know if the cycles will continue. Maybe US dominance is permanent. Maybe it's not. But I do know that 53 years of data shows rough parity. And I do know that international has been cheap compared to the US over the last decade. And valuations eventually matter in my opinion. So I'm keeping a meaningful allocation, just about 10%. But it's not the full 40% that Vanguard recommends. If I'm wrong and US continues to dominate, well, I've still got, 90% in US stocks and I'll do fine. If I'm right and mean reversion happens, I'll be glad that I held that 10% just to help off weight a little bit. Now, I diversify in other ways, but this is just one of the ways that I've added to my portfolio. Okay, so here's what I've learned so far. Everybody right now thinks that international stocks are a complete waste of time. And if you look at only the last 12 years, they're completely right. But 53 years of data tells a different story. International and US stocks have basically kept pace. Each has had its moment. Each has had long cycles of complete dominance. International was ahead though for 47 years. In 2007, they had a $926,000 lead in this experiment. The US has only pulled ahead in the last year. So the question isn't, are international stocks bad? The question is, has something fundamentally changed or is this just the latest cycle? I don't know the answer. Nobody does. But I do know this. Every single time in history that people have said this time is different, well, they were wrong. The Japanese dominance in the 80s didn't last. Dot-com era of US exceptionalism didn't last. Emerging markets boom of the 2000s didn't last. Maybe this time it really is different. Maybe the US structural advantages are permanent, but 53 years of data does make me skeptical. So I'm keeping about 10% international, not because I'm confident that it's going to outperform, but it's literally because I'm humble enough to know that I could be wrong about all of this. And if I've learned anything from studying these 53 years of market history, it's this. The confident predictions are usually ones that age the worst. Now listen, if you want to dig into the data yourself, I've put together a free spreadsheet with the 53 years of returns, the decade by decade analysis, everything is going to be linked in the description of this video. And if you want more of this evidence-based personal finance content where I'm actually showing you the data instead of just repeating conventional wisdom here, make sure you subscribe, hit the bell button, and I'll see you in the next one.